everyone to our April meeting via Google Chat or YouTube. My name is Ariel Drummond, and I am the president of the Central Jersey Professional NSBE chapter. Thank you for joining us. We have our secretary joining us live as well, and Marie Andre is here to discuss how money works with us. So, Marie, if you would take it away.
Good evening, everyone. Thank you for having me. I do appreciate having this opportunity to speak with you all. My name is Marie Andre. I've been with Primerica Financial Services for 7 years, and I will be discussing tonight how money works, but it's a little bit of a twist to it. I do focus more on the African American community and how our finances are affecting us and how we need to make some changes in our endeavors in the future with our finances. So with that being said, I'm going to begin with the presentation. Again, I'm with Primerica. It's been around for over 35 years. You know, we have a great standing behind us. We have over $600 billion of term life insurance. We have over 2 million investment clients. You know, accredited member of Better Business Bureau. We're doing business in one of the highly regulated industries. You know, we've been around for a long time. We're doing what's right for our families. We don't just do life insurance as many people think. We do a lot of different things. I'm actually licensed to do life insurance, long-term care, Series 6 and 63, which means I can do investments, rollovers, 529 education plans for families. So when you have a Primerica rep working with you, it's not just a one-stop shop. Well, it is a one-stop shop, excuse me, but it's the person who can do everything for you from the beginning to the end. It can help you with your finances and get you get out of debt and retire financially sound, and that's one of my major focuses, especially in the African American community. What we're finding is that 80% of African Americans do not have any kind of wealth-bearing or investing accounts in their households. So we're being left behind the dust. There's actually a man named Dr. Claude Anderson, if you ever heard of him. He does a lot of speaking about African American and wealth, and he's saying that right now we have an epidemic, but we're not saving enough. We don't have any bearing in this country. If you think about it, America is a capitalistic country, and right now we don't own anything. African Americans are known as consumers, not producers. You know, next year, 2015, our consumer spending will be $1 trillion, but we're spending it on things that depreciate as opposed to investing in building businesses or ownership. So I like to focus on those aspects when I speak about finances, because it starts at home, but we have to look at the bigger picture as a people. So again, we focus on all areas of finances, so life insurance, managed accounts, which are bigger investments accounts, annuities for retirement. We do 401ks, mutual funds, legal protection, auto and homeowners insurance, long-term care, and debt solutions. So again, we cover every aspect of finances. So what we're going to talk about today is what you can do. You can get out of debt. You can build savings. You can get on the path of financial independence. But first and foremost, you must take control of this. Oops, sorry. First, you have to take control of what you can control. You know, you can't control Social Security, but you can save for retirement. What they're saying now is that Social Security is going to run out in possibly 20 years. What are you going to do if you have nothing set up for that? You know, you have to look outside of the government or a pension to support you once you retire, because God willing, you will retire at some point. What's going to happen if you haven't started saving for it? You can't control your employer, but you can have other sources of income. There's numerous articles and books about having outside income, because jobs nowadays aren't paying as much as what they used to, and a lot of companies are downsizing. What companies are doing now are trimming the fat, as we call it, which means they're getting rid of people so they could keep cash on hand, as opposed to back in 10, 15 years ago, there was abundance of jobs. Now there's a scarcity of jobs because companies don't have to hire any more people. And I respect our president, but a lot of companies aren't going to create more jobs for people because they don't have to. It's not in their bottom line. If they can make one person work 2 jobs and pay them 1 salary, that's what they're going to do. So we have to go back to the entrepreneurial state that this country was founded on and find other sources of income. We can't control our taxes, but you can control ways to reduce your taxes. Inflation is there, but you can maximize your savings in the proper investment vehicles. Rising costs, again, that's inflation. All you could do is save more for that. The risk of a single investment versus diversification. So first, what we always talk about is pay yourself first. I can't stress this enough, how important it is to put aside at least 10% of your income towards yourself. Pay yourself first is very imperative, and we'll get into that a little bit later. Excuse me. Adjust your priorities, change your thinking, adjust your lifestyle, earn additional income, avoid the credit trap, and I'll be covering a majority of these things, and setting goals and having a plan. So first and foremost, pay yourself first. There are 3 types of accounts that you will need. First, you need an emergency fund. Emergency fund is considered, if you are a renter, it's 3 months worth of your expenses saved. So if every month your bills total $3,000, you would need $9,000 saved. If you're a homeowner, it should be 6 months of your expenses saved. So that would be $18,000. And that's for emergencies. A lot of people are falling back on their credit cards, and it's causing them more detriment because they're trying to catch up and pay off these credit cards that are high interest, and they never seem to pay them off, which keeps them in the epidemic of debt. Right now, we as African American are enslaved to debt. We purchase so many things on debt or on credit, but we're cash poor, and it's really hurting us as a people, and it's keeping us behind. The next type of saving is short-term savings, so anywhere from 1 year to 5 years. So if you want to purchase a car, go on a vacation, or buy a computer or a new flat screen TV or something to that effect, put that into a separate account as well. And then long-term savings, so retirement, 5 to 9 college planning. These 3 savings accounts are really imperative that you have each of them because they're all important in their own right. It's important to use your time wisely and consistently. It's better if you start saving young, but at this rate, even if you're older, it doesn't matter. Start saving something because it's better to have something than nothing at all. I come across a lot of clients who are in their 60s or even late 50s who are now thinking about retirement, and it's a little too late for them. But if you're in your 30s and 40s, this is a great time to set money aside because, again, God willing, retirement will happen. What will happen that day when you're 65, 67, 72, or whatever the retirement age is, and you have nothing saved? Today, the national average for retirement or for people who are retiring is $25,000. That's not enough. That won't get you anything anywhere, especially not in New Jersey. So what are you going to do when you are at retirement age and you have nothing set aside? It's imperative that you start making sacrifices now towards your future. Cut back on maybe your cell phone bill, cut back on your cable bill, and put an additional $50 or $100 and put it towards your retirement. It makes all the difference. I'm 35, and I know for me to retire somewhat comfortably, I would need $3 million saved. Now, just to save $400 a month for 30 years will get you $800,000. So you'd have to basically save over $1,000 a month to get over $3 million. So that's why it's important to start when you're young, because you have that ability to build and for your money to grow. But again, it never hurts to save. Even $800,000 is better than nothing at all. It's better than $25,000 I just mentioned. Wouldn't you agree? So the high cost of waiting. Here's an instance where if the person's putting away $100 a month at a 9% interest-bearing account, what happens at age 67? If they started at 25, they'd have over $560,000 saved. If they waited just 1 year, they lost almost $50,000 in savings. If they waited 5 years, they lost over $200,000 in savings. And if they waited 15 years, they lost over $400,000 in savings. Now think about that. Just taking a year or 5 years to think about it, to question it, to debate it, can really hurt you in the long run as far as your savings are concerned. So it's imperative now that you start saving your money towards retirement because it's going to happen. Why not be prepared for it? And one of the ways that I educate my families is the Rule of 72. I'm not sure if any of you have ever heard of it, but it's essentially a simple calculation that shows you how fast your money is going to double. So in this instance, if you were to have $10,000, let's say the 3% is a savings account, which is a very generous savings account because no savings account nowadays are giving you 3%. They're giving you less than 1%. Let's say the 3% is savings account, the 6% is CD, and the 12% is the stock market. If you were to take 72 and divide it by 3, it would take 24 years for your money to double. Now, if you were to put it in the 6% bearing account, it takes 12 years for your money to double. Now, if you put it into 12% bearing account, take 72 divided by 12, that'll give you 6 years. It's important to know this calculation because this is how credit card companies, banks hurt you. Because right now, you're getting 1% of the bank. So if you were to have $1, I like to make this as simple as possible. If you had $1, you put into an account at 1%, divide 72 by 1, it'll take 72 years for you to get $2. And another 72 years for you to have $4. Do you have that much time to wait for your money to double? And a way the bank hurts you is that they're taking your money and investing it into a 12% bearing account, and they're getting money every 6 years, but you're getting it every 24, 12, or however long it is, whatever account it's in. And think about credit cards. Credit cards are at 30%. So that money is doubling every 2 years. And you wonder why people can't get out of credit card debt. It's imperative to know the rule of 72 and how to apply it in your savings. You know, a lot of people ask me, well, where can I get 12%? I firmly believe in the stock market. I'm invested in the stock market. It's a great tool. I understand a lot of people are scared of it because it's risky. But if you educate yourself on it, you could manage the risk. Driving your car is risky, but wearing a seatbelt helps you manage and reduce the risk. It's all about educating yourself or finding a financial consultant who will advise you properly. And yes, I'm a financial consultant, but I would suggest you go out and interview different people. I'll offer you a free consultation at the end of this, but you're free to go talk to several people to find who you're comfortable with. Because at the end of the day, it's your money, and you want to make sure they're doing right by you. So it's important that, when you do sit down and talk with someone, you talk to them about the Rule of 72 and other concepts that we discussed in this presentation, okay? So at the end of this, after 48 years, you could either have $40,000 or $2.5 million. What would you rather have? And how many doubling periods do you have in your life? Second is to eliminate debt. Now this goes back to the Rule of 72. Again, if you had a one-time $3,000 purchase and you made the minimum payment, it'll take you 10 years to pay it off. And you end up paying $2,000 interest charges. So you're paying over $5,000 for a one-time purchase of $3,000. Is that worth it? Does that make sense? What could you have done with that additional $2,000? You could have put that toward a retirement account, towards your children's education account. Again, we have to think about what we're doing and change some of our thinking and adjust some of our actions. It's nice to buy a Louis Vuitton, but why not invest in Louis Vuitton? Why not invest in some of the companies that we're purchasing or that we like to brandish? It makes sense to put money where it's going to grow faster as opposed to buying a depreciating product. I've seen a lot of people who have nice flashy things, but they have nothing to show for it. You could have a BMW car, but if you have no money set aside, what happens when that car breaks down? How are you going to get out of debt once you have no money? And speaking of debt, there's revolving debt versus fixed debt. Now, revolving debt is a credit card debt. And essentially, you're getting charged interest with a credit card every day. It's always a changing amount. That's why if you make a payment, you're like, what happened to my payment? I don't see it going anywhere, because a large percentage goes to interest because it's always building interest on a regular basis. As opposed to fixed debt, it's the same amount of money you pay every month, and a certain percentage goes towards the interest, a certain percentage goes towards the actual payment itself. And if you see in this example here, it's the same amount of money at the same interest rate, paying the same per month, but because it's in a fixed debt, or because it's fixed debt, you pay it off faster. So it makes more sense to have something like a car note as a fixed debt. To give you an example, you'll pay your car off, and it's better for your credit than a credit card, because credit cards, the interest rates are so high, and it just takes you longer to pay them off. It's really not worth it. I understand credit's important, but having cash on hand makes you look even better. And one of the ways we educate our families on how to get out of debt faster is something that we call debt stacking. A lot of companies call it different things. Susie Orman calls it her debt elimination program. Dave Ramsey calls it snowballing. People have different names for it, but essentially, if you look at this example here, if you take the retail credit card and you're paying that off $220 a month. Once you pay that off, take that $220 and add it to the second credit card. So instead of paying $353, you're paying $573, and so on and so forth. And that'll help you get out of debt way faster. And if you see, you're not changing the amount you're paying per month, but you're taking the additional money that you're paying from the previous bill and putting it towards the current bill, and that helps you decrease in interest. If you see here, without debt stacking, it would have taken 23 years for you to pay off that debt. But with debt stacking, you do it in 9 years, 14 years sooner, and you save over $130,000 in savings. What could you, interest, sorry about that. What could you have done with $130,000? You could put that towards a home. You could put that towards starting a business. You could put that towards your retirement, to your children's education. Again, it's about making better decisions moving forward. I'm just trying to educate you on what you can do differently. There's little tweaks that you can make that make the biggest difference in our everyday lives. And again, I stress that we need to save and put money aside for ourselves and to create businesses and to create more African American businesses, because right now we don't own anything. There's some people who have businesses and companies, but there's not enough. There's actually a study that shows that within the Jewish community, the money stays within the community within, I guess it's 12 bounces. Within the Asian community, it's 16 bounces, which means it'll go into 16 people's hands within that same race. In the Hispanic community, it bounces 6 times. In the African American, it bounces maybe once. So that means once we get our paychecks, we're going to everywhere else to spend our money, but within our own communities. And we wonder why we're not progressing. So again, it shows you here that spending the same amount of money, you will get out of debt way faster and save a lot more money. 5 common mistakes of credit cards, or common credit mistakes, is not valuing your credit. Your credit is very important. Your credit is just as important as your Social Security number nowadays. Jobs are looking at your credit report. If you have bad credit, they're not going to hire you. Your credit card limits are dependent on your credit report. Getting cable, getting your cell phone, getting a car loan, everything is dependent upon you having good credit. So it's important that you monitor it. You can get a free credit report every year from annualcreditreport.com, and that's annualcreditreport.com, and you can look through it. I know for me, one year I had other people's names on it. I had things that weren't mine. I called them up and cleared it up, and that raised my credit score substantially. So make sure you check it on it, and it also helps you monitor if you can have identity theft, because you can combat that. Monitor your credit score. Know what you are. Know what you have. There's 3 different credit bureaus. There's TransUnion, Experian, and Equifax. Make sure you know all 3. And if you don't know what your FICO score is, find out. And the FICO score is usually the median number. So if Equifax is 670, TransUnion is 690, and TransUnion is, I'm sorry, did I repeat that? Is 700, you'd be 690. So it'd be the average of the 3, or the middle number. And not knowing your interest rates and fees. We get credit cards all the time, and we don't know what we're paying in interest. And that's what hurts us the most. We like to go into the store like Raymore and Flanagan and don't pay anything for a year. And then if you miss a payment after that year, it goes up 30%. So it's important to know what the loopholes are and what the fine print is. Another way that we educate our families is buying the right kind of life insurance. Now, in our community, what I find is that we're being sold the wrong kind of life insurance. And the reason we're being sold this kind is because we're not taught properly what we really need life insurance for. Now, what life insurance is protection management. It's there just in case something were to happen. It's not a retirement fund. It's not a way for your kids to go to school. And, it's not a savings account. It's a protection management vehicle. So if something happens to you, your family has money to bury you, and they have money to pay off any debts you would have left behind. Now, think about it. You insure your car. You insure your home, but what about your life? And it's not that your life has a number to it, but it's just that you're bringing home income. You're bringing home something to your family every day, and once you're gone, that money's no longer there, so how are they going to survive? Now think about it. How many times have you gone on Facebook, or you've seen on Facebook, people raising money to bury their family members? Think about the detriment it's doing to that person to have to ask strangers and other people to raise money to bury their family member. Not only are they suffering from the loss of their family member, but now they have to suffer with the embarrassment of asking for help. You can alleviate this by getting life insurance. So you can't afford not to insure your life. I know a lot of people say, I don't have the money for it. Well, you don't have the money not to have it. And the reason that we believe in life insurance is because of these reasons. As I was saying before, it's the theory of decreasing responsibility. In your early years, right now, we have a lot of debt. We have college loans, mortgages, car notes. You're bringing home income. If something were to happen to you, how is your family going to survive without that income? What's going to happen to your children? What's going to happen to your spouse if all of a sudden you lose your job or you lose your life and you're no longer bringing that income? But what we believe is, have as much insurance as you can while you're young, but as you get older, you should be saving money towards retirement. So by the time you are of age, your children should move out, hopefully. Nowadays, you don't know. You should lower your debt, pay off your mortgage and your car notes and everything else, be ready for retirement, and your mortgage should be paid off. So you don't need as much money saved. So in the earlier part of your life, if you had $500,000 life insurance, you'll be okay to cover your family. But if you have $500,000 saved, you don't need life insurance anymore because you have that money there. Now think about this. How many life insurance agents will tell you they want you to stop paying life insurance premiums at some point? Primerica is the only company that will tell you that because we want you to save money in a retirement vehicle and you don't have to pay premiums anymore. For some reason, we're fixated on this. We need whole life insurance. It gives us a savings account. It's a wonderful thing. It's not. In all honesty, the reason that financial advisors, consultants, professionals sell the whole life policy is because they get a bigger commission off of it. They have the same opportunity to give you term life insurance, but why do that if they can make more money off of whole life? And I'm a very frank and honest person, so that's what it is. I don't do whole life. All I do is term, and I don't see the benefit of whole life for most families because it costs more money in whole life than it does term. And I'm not the only one who feels this way. We have different articles that say term life insurance, by contrast, provides a larger death benefit. Hello? I thought someone said something. For less money than whole life. Most families are better off using it to protect against the death of the breadwinner. So again, it's here for protection. It's a service being provided. If I hear another person say, I've been paying all this money into it, and I'm getting nothing out of it, I'm going to lose my mind. You use car insurance, you don't get money back for that. You have homeowners insurance, you don't get money back for that. You're paying for a service. You're not paying for something to give you something back. That whole setup was there just to sell a product at a higher rate. And again, here's an example of whole life versus term. Whole life is the yellow one. It costs 3 times the amount, but you're getting 1/3 of the coverage. Now, why pay more for less? That makes no sense nowhere else. But why does that make sense in the insurance industry? Please, someone help me understand that. And on top of it, what a lot of the financial advisors don't tell you is that with that savings account that they sell you on that you need, it takes 3 to 5 years before you see any money in that account. 2, your interest rate is 3 to 4% growing, which is comparable to inflation, but it's not really growing that much. However, if you want to take that money out, you're taking a loan against your own money. Now, would you open up a savings account in Chase if you had to take a loan against it? I don't think so. It makes no sense to do that. And then the kicker of it all is that when you pass, your family only gets the face value or the greater of the two. They don't get both. So if you have $100,000 face value and $20,000 in the savings part of it, your family will only get $100,000 because by law, the company cannot give you more than what the face value is. So they're selling you a product that's hurting you, and you don't know this, and they're banking that you don't know this. So again, never buy any kind of cash value, whole life, including universal life, which is a bigger debacle. Never buy life insurance as an investment. And never buy a life insurance policy that pays dividends. It's just no benefit to families nowadays. And if you don't believe me, I always give this disclaimer. My name is Marie Andre. I'm a representative of Primerica Financial Services. You may feel that I'm biased and try to sell you a product. I suggest you go onto YouTube, look up Susie Ormond Life Insurance, type in Dave Ramsey Life Insurance, and say the same thing I say. They have no affiliation to Primerica, no affiliation to me. They are syndicated, they are popular, they're on TV, they have books. I don't have any of that. So if you want to, go to somewhere else and see what they say, listen to how they feel about it. Deferred taxes. Now, as far as savings are concerned, a lot of people ask me, oh, where can I save my money that it's going to grow? Everyone's scared of the stock market. But in this instance, the yellow is a savings account at a bank. So there's no taxes deferred, so it's after-tax money. The blue is like a Roth IRA, so it's after-tax money, but it's going to an investment vehicle in the stock market. And the green is a traditional IRA that's going in before tax. And what you see at the end is that your money grows faster, tax-deferred and tax-free. Now that's a beautiful thing. Now the only thing with traditional IRAs, when you take the money out, you are taxed on it. But it's important to know where you're putting your money and that it grows faster and it grows better if the taxes are deferred or tax-free, as opposed to putting into savings account. And a lot of people say, I'm scared of the stock market, but I always give this example. If you were to have $100 a month and put into a savings account at 1%, for 30 years. After 30 years, you'll have $42,000. If you were to take that same $100, put into an account at 9% for the same 30 years, you'll have $180,000. Now, if 2008 happens again and you were to lose 40%, you still have $108,000. So you're still $60,000 more than you would have been in a bank. So what's really safe? Where are you really taking the risk? So it's important to know, again, the rule of 72, where you're investing your money, and, the best vehicles that work for you. Become an owner, not a loaner. Again, I said this earlier before, is we teach families where to put their money. Again, you're putting your money in the savings account. They're giving you 1% or less, but they're taking your money and investing in the global economy. Well, we tell you to bypass the banks or the financial institutions, and we show you where to invest your money. And as far as long-term savings are concerned, there's 3 different kinds. These are retirement accounts. There's Social Security, company pensions, and personal savings. Now, right now, that's what we should have, or that's what we have, but in 20, 30 years, Social Security won't be around. Most companies are moving away from pensions because they cost them too much. So now all you're left is with one leg, your personal savings. Now, if you weren't saving personally, what are you going to do? Again, I can't stress enough the importance of saving for yourself. It's not the government's job to take care of you. It's not your company's job to take care of you, and they're not going to do it. We are in so much debt as a country, they can't afford to do it. So you have to figure out a way to do it yourself. So here's just an example of inflation and the importance of knowing money. If you see in 1981, $24,000 is now worth, $10,000 is now worth $24,000. So it's important to know inflation when you're investing your money and making sure that you're keeping up in pace with that. I apologize for that. I was distracted for a second. And one of the reasons I go into this part is because I want to stress the importance of having additional income or finding a side business that's going to help you in the long run get towards your goals. This is actually from the book Cash Flow Quadrant from Robert Kiyosaki. And he talks about knowing the difference of, being an employee, self-employed, business owner, and investor. A lot of us we're taught to go to school, get a good job, and stay there and then retire. Well, those days are long gone because, you can't stay at the job for 30 years anymore and expect a pension or for them to take care of you. That's just not happening. But we are taught to be employees. We're not taught to be business owners. And as an employee, your income is based on your job. So think about it. At your job now, do you know someone who works really, really hard and someone who doesn't? They generally get paid the same amount because they're not getting paid on their contribution to the company. They're getting paid on their position. And this is where you have no control. You are controlled by your employer. They tell you when you can have vacation, how many sick days you can have, everything. So you really have no control of time or money. Now you can be self-employed. Now if you think about your doctors, your dentists, your OBGYNs, they own their job and they're people who are very self-sufficient. But the only downside is if your hairstylist were to break her hand, what would she do? She's dependent on herself. She can't then work if her hand is broken. So self-employed is better than being an employee because you have more freedom, but you're still limited to what you can and cannot do. However, as a business owner, you control your time and your money. And I like the business owner aspect of it because there's so many companies out there now that you can buy into. You can be part of a franchise. Yes, Primerica does it, and I'm not trying to sell you on Primerica. I'm just trying to tell you that there's different things out there that you can do, that you can keep your full-time job, work part-time, put your money towards paying off debt or saving to, do a bigger business. If you wanted to have your own, skincare line, you could save money for that. And this is a way to do it where it's low cost. Most businesses nowadays cost over $200,000 just to start up. And that's, you have to build, get location and supplies and employees. Whereas if you buy into a franchise that's already set up for you, you don't have to worry about all that. But most franchises like McDonald's or Burger King or Chick-fil-A, they cost $20,000 to up to $1 million to invest in. Why not find like a multi-level marketing business that's out there? And there's so many that are out there. And I'm sure you can find something that will interest you, that you can make that additional income. And another benefit of being a business owner is taxes. You get so many tax write-offs as a business owner. And again, I respect our president, but he can't, essentially he can, but you can't really ask the rich to pay more in taxes because they know how to shield or shelter their money where they don't have to pay more taxes. And it falls back on our backs, middle income America. So, again, they know how to hide their money through C corporations, through LLCs, whereas for us, the employees, we're going to have to pay more. Why does Mitt Romney only pay 15% tax, to 15% on his taxes, but most of us pay anywhere from 28% upwards to 33%? We have to think about that. It's because they know where to shield their money. So we can't think that, the rich are going to get taxed more because they know how to shelter their money. And then finally, there's an investor. They have money working for them. Now, these are people like Warren Buffett, Bill Gates. They have a plethora of money, so they can invest their money into different things. But why not work towards being a business owner? If you're an employee, why not get a side job and have additional or side business, have money coming in and having things written off? It makes such a difference. And especially a lot of you guys are engineers, so you guys make a decent amount of money. And I'm sure a lot of you worried around tax time, like, oh, am I going to owe? Well, if you had a business, it'll help you offset that tremendously. So I can't stress to you the benefits of having a side business. And I know some people are going to say, I don't have the time, I don't have the the wherewithal, or whatever the case may be. But if you wanted to get another degree, you'd go back to school, wouldn't you? You'd make time for that. I think it's just as important as getting an additional degree, but this way that teaches you how to save your money, helps you in the long run, and also helps your family. And it helps the community because another African American business will help us grow as a people. So why not do that? So what side do you want to be on? So again, working for yourself pays. Now here's a comparison of people who are employees versus those who are self-employed. You see the big difference. The net worth is, what, 4 times the amount? Probably more than that. 5 times the amount. Why not try something different? And I'm going to end with this. Now, this was a study done back in 2001, or actually it's earlier, before that, but it was published in a book. It tracked 100 people from age 25 to 65. And what it found is that at retirement age, 54 were dependent on someone. Dependent on Social Security, dependent on their family, or dependent on the government. 36 were still working. 5% were deceased. 4% were considered okay with $1 million saved. And 1% were wealthy with $5 million saved. Now, why is that? And that's because they had the financial education. Why did 95% not make it, but 5% did? They had the financial education to do it. They had someone helping them. And what I want to offer to you today is a free consultation with me. There's no obligation. You just sit down with me, I look at your finances and see if you're on track or tell you what you need to do. Why not be in part of that 1%? Why be with the rest of everyone else? Why not today make a decision and make a difference? So you can do it. The path to financial independence starts with understanding a few basic concepts, and hopefully I hope I was beneficial in displaying them to you. And, again, it's winning the war in the financial battles day to day. It's about making those sacrifices. It's about not buying the Starbucks coffee every day. It's about bringing your lunch to work. Those things make all the difference. It's about not buying an $800,000 watch, but buying a $100 watch or even something $50 and putting that money towards an investment vehicle. It's about saving for your future. Here's my information, my cell phone number, and my email address. So if you guys want the free consultation or have any questions, feel free to contact me. I'm available at all times. And with that, I'm done. So does anyone have any questions?
Thank you, Marie. Actually, I do have, can you hear me?
Yep, just fine.
Okay, great. I actually have a few questions from the YouTube channel. The first question here, let me get the questions. There's discussion going on in the YouTube channel.
I guess that's good.
So the first question was, can you transfer term life to another carrier? So if you have term life insurance, can you transfer that to another carrier?
No, you'd have to cancel it and then get a new one.
Okay.
You can't transfer any of the life insurances now.
Okay. The second question is, what are your recommendation, or what are the recommended options to establishing credit without credit cards?
Well, it depends on their finances. If they can purchase a car, that essentially is it. I mean, if you have student loans, you can show by paying those off on time. I mean, I'm not completely against credit cards, but if you're going to have a credit card, use it for like your monthly gym membership. Only put a certain amount on it per month that you're going to pay off every month to help build your credit. But the better things I would suggest are fixed debts like car notes, buying a house, but those are big things. So if you're a college student and you want to start establishing credit, I would say get a credit card, but get something that has a limit of $250 or less and utilize that, but make sure you pay it off every month, because what your credit is based on is the length, how long you've had your credit, the amount of money you have available to you at credit, and how you're paying things off. So if you show that you have responsibility in paying things on time, that'll help your credit score.
Okay, great. Thank you. Actually, I had a question for you.
Mm-hmm.
You were speaking about, sorry, I lost my train of thought.
That's
There's
okay.
a lot going on. So we're going to come back to my question because it was, I should have wrote it down. But we also have another question about, someone asked, do you have any thoughts on real estate versus the stock market?
Ooh, that's a good one. I like them both, but the only thing with real estate is it's a little bit more of an investment, because with houses, you have to worry about tenants who don't pay. You have to worry about things that happen in the house. Houses always need work. Especially when tenants move out, you got to repaint. You have to worry about roofs if there's a storm, and they take longer to appreciate than the stock market can. So I think the stock market, you probably get a better rate of return, but the longevity of having a house is also good too, because after a certain amount of time, you will have equity in the home, and it does look good on your financial report if you are making income on it. I wouldn't say just buy a house for the sake of buying a house to help your investment vehicle, but if you're going to buy a house as an investment vehicle, make sure you're making money on the house and you're not losing money. They say that for every door that you have in the house, like if you have a two-family, you should be making anywhere from $250 to $500 per door. If that makes sense. Like, you want to make sure you're cashing in and you're not paying out on the house, because then it's no longer an investment, it's now a liability. I hope that helped.
Okay. The other question was that I remember now. bit about credit reports. So if you have something negative on your credit report that is an error, who
Hmm.
should you contact in order to get rid of that on your credit report?
The actual credit bureau. So if it's on, because sometimes they'll have different things on it. So if TransUnion has, you opened up a credit card in Macy's and you never did, you could either write them a letter or call them up, and then you have to contest it.
Okay, and how long does that usually take to contest? And
Well, all right, this is a little trick. And I didn't tell you this, but this is a little trick.
you're
Technically,
you're live on YouTube.
no, but this is fine because a lot of companies do this, and a lot of companies help people get out of debt or get their credit better by telling them to do this. If you have something on your credit report that you want off, you can write the company a letter. So TransUnion, Equifax, Experian, they have 30 days to get back to you on that. If they don't do it in 30 days, they have to take it off your credit report.
Okay, so
So,
write them a letter.
yep,
Email it or mail it.
mail it.
All right,
Again, you
just
have the
clear.
option to call them, but with a written letter, it may take them longer to get to it. And if they don't get to it in 30 days, then they have to take it off.
Okay, thanks for that tip. Another question: what are good plans for saving for kids, like for college, etc.?
A 529 plan is a great investment vehicle, and they have different ways to do it. There's ways that you can do it for a certain amount. So if you want to save 200,000, it'll tell you how much you need to save per month. And right now, if you were to have a kid today, in 18 years for a public school, it's 200,000. For a private school, it'll be $400,000. You'll need by the time they're 18. Um, but I always do make this disclaimer. I always tell my families or my clients, if you have an option between saving for your retirement and saving for your children's education, save for your retirement. They can get loans, they can get financial aid, they can get scholarships. You will not get any assistance with your retirement. So if you have to choose between the two, I would strongly suggest you focusing on retirement. But again, there are 529 plans. There's a Coverdell, which helps for anything under college. So if you want to send your kids to like a private school, very fancy Catholic private school or something to that effect, you can start saving money when they're born, or even prior to that, and start saving money in an account, and it could be utilized for K through 12. And then for the 5 to 9, it's only college. And with the 5 to 9, you can use it for a trade school only if they get certification from it.
Okay, great. Thank you very much. I think that's all the questions that I have here in the YouTube on the YouTube channel.
Okay.
So again, thank you so much for speaking with us today, and we will definitely pass along your information, and you will be live on our YouTube channel, and the recording will be available for those that were not able to join us this evening.
Wow. Well, thank you so much for having me. And again, I hope that the information I imparted today was beneficial. Again, my focus is education and just getting people aware of what's going on out there because we don't know what we don't know.
Yes,
So I definitely hope that what I, shared with you today was something that will definitely make you think from this point further.
and it was definitely. I learned. I definitely learned some new things today, and I believe the people that have joined us live have also learned a great deal as well. So thank you so much, and we look forward to having you back next year.
Oh, thank you so much.
Thank you.
All right. Have a great night.
Thanks, you too.